Well, you know what they say, when markets get greedy, we might need to be getting fearful. And that's exactly what's happening here with the largest sell ever by NVDA CEO in the markets over the last week. This, coupled with the S&P 500 and NASDAQ hitting massive psychological levels and rejecting them, exhaustion signs, and dark pool activity everywhere, led us into this point that we are at right now. So what's ahead for markets around the world, and what have we seen kind of happen several times now through the bull run of 22 into 24? That and more coming up in today's show. This one's not to be missed, guys. Let's get into stocks, commodities, and cryptos for the week ahead. Well, welcome back everybody to The Daily Show, where we talk about markets around the world together. My name's Tom. Today we're discussing the latest macro, data, and of course, Wall Street's largest flows. If it's your first time here, remember subscribe and smash the bell icon, as we've got some amazing data to share with you each and every day to do with these markets to help you gain edge in what's happening next. Let's get into the first story though, and that is of course the similarities with the current market and what we've seen in the 1990s and of course the 1960s. What was the similarity? Low breadth. Basically, we had a concentrated market with a few companies going absolutely ballistic, such as NVDA and AVGO right now, and we then ended up going into what we call a hyper bubble. Now, as you may have noticed over the last week, everyone's now using the word bubble. Now, I'm the first to tell you that even if we do get a pullback here, it's unlikely to be the end just yet, because when the word bubble becomes used everywhere, there's usually more to go. But let's explain that with some figures and stats in just a few moments. And firstly, have a look at whether we're getting a pullback right here, right now. Now, why could we mention this? Well, because of course, the CEO of NVIDIA, Jensen Huang, just sold over $31 million worth of NVIDIA shares this week, marking it as the largest sell he's ever done in 19 years. Now, why is this important? Well, in some ways it isn't. Insider selling actually doesn't lead into necessarily a market falling down. But I thought it was very interesting to bring this up because not only has he become a billionaire off just the sales alone, but he's also never bought back the stock, of course receiving it as part of his salaries. So has he done well? I would say most people that have been holding NVIDIA would certainly not begrudge him this money, as I'm sure they've been made, and maybe you've been made, relatively better off thanks to NVIDIA stock. So let's talk about the clock ticking for stocks and bonds. All right, sure, the market's going up. Sure, we've got some big dark pool transactions coming up in today's show. But what about the beginning, eventually, of the Fed cuts? Now, we've already shown on this chart that Fed cuts don't necessarily crunch the market. But in similar situations, such as what we're reading right now, when we do get cuts, we need to be on the outlook for S&P 500 declines. Now, some of them are worse than others, and of course the most notable ones were the global financial crisis and the dot-com bubble, which is something we've been looking at, and then the end of the 60s run, which of course ended up into a very, very nasty market, indeed at 37.27%. Now, why is this important? Well, the Federal Reserve generally doesn't cut out of the goodness of their heart, and instead they cut because something is broken in the economy. And that hasn't happened just yet, but have a look here for how long it usually takes for a cut to come after the Fed pauses. We've actually now been paused since 2023, and we're now leading into one of the highest periods of time where we haven't put a hike in since the global financial crisis. You can see over here, June 2006 to September 2007. Now, do I expect this market to actually go higher than this? I would say so. Most people are expecting a September rate cut. I tend to believe they might even hold it till 25 and see what they can do. But we'll end up seeing this in the history. The main thing here is to not be predictive on this and instead to be looking at the price action itself. Now, where is this time different? Of course, the dot-com bubble was just huge overvaluation of certain stocks. And then the 60s was a totally different market once itself. Now we seem to be leading into possibly the buy now, pay later, let's leave all of our money in debt and basically have a great lifestyle. And by the most recent survey of respondents planning to travel for leisure outside of their area of residence during the 2024 season, effectively everyone was thinking about doing it on multitudes of different ways that, funnily enough, are often not tracked by some of the biggest numbers in terms of the central banks. Now, why is this going to be important? I think it's the buy now, pay later, which is still relatively small, that's starting to rise. And what you'll notice is disproportionately, it seems to be going up as a percentage of people that live either paycheck to paycheck or have issues paying bills. And I think this could be one of the things that people will want to look at over the next coming year to see whether that continues to rise. The next big possibility of markets having a little bit of a hiccup here has to do with sentiment. Are we just getting way too bullish? You can see here Grand Hawk region all-star charts. Sentiment indicator is starting to come back down to some periods where, tends to be leaning into maybe a little bit too bullish. And when that happens, well, you need to be paying attention to it. Sometimes it drops the market, sometimes it doesn't. The thing about sentiment reads is you need price action to be coming with it. And as we see here on the AAII member survey, it is starting to lead into neutrality and hugely bullish, with bears basically getting smashed over the last week and falling to one of the lowest reads we've seen in a very long time. Historical averages, we usually see around 31% of bears come through the markets. And of course, now we're seeing 22.5%. So this is very, very low. And it does make you say, well, maybe I need to pay a lot of attention to this 5,500 level and 20,000 level. Here are some other reads that kind of show you how far things can go. At the moment, we're trading with the top 10 large stocks at 30 times company multiples. That was actually at 47 times during the dot-com bubble. And it also had that similarity with the market itself underlying not being too bad, but the big stocks just being absolutely overpriced. And of course, anything back here that mentioned the World Wide Web was going up, and everything over here that mentions AI is going up. I've often said this, and I still expect it. I expect some IPOs to come out of some of the angel investment over the last couple of years and start to IPO in the market back end of 24 into 25, especially after the election. And I think this could be one of the signs that the market is getting very toppy, especially from an investment perspective. Let's wait and see how they end up coming through. Now let's talk about some of the largest transactions that went through the markets over the last week. A massive one coming in here from the SPY. And of course, I do pay attention to these because if you get a massive trade, well, it can lead into some really good gains. And if you're on the sell end, it can lead into, of course, the market dropping. Remember these two back in the April kind of period, we got two large reads. Well, they did quite well and they've led into some nice profit. At 550, we see this huge sell. And it wasn't just that. It seems to be going through a couple of markets. NVDA showing two massive transactions going through near these highs. And then Broadcom, probably one of the hottest stocks recently, also showing two really large transactions. Now, we never know whether they're buys or sells completely. But what we can say is that I would imagine somebody's on quite a lot of profit, and it makes sense to be maybe liquidating a little bit of that profit right now. And maybe the markets will gradually come back down to a much nicer level. And of course, while I don't think it's the top of these stocks, I do think it's telling us a little bit about a phenomenon that's happened many times now, which we'll show you later on today's video, during the 22 to 23 to 24 bull run that we've been in so far. So if you haven't seen this chart yet, we brought it up in our last video. We talked about the soft landing concept and how far along we were into the soft landing concept. Now, funnily enough, in a lot of these soft landing concepts, we ended up getting pullbacks in two of them anyway at around this period of time, around this July equivalent of 2024. Now, which ones were they? Well, they were the 1960s version, and funnily enough, they were, in this case, look at this, the .com net level. Now, I'm not saying that's exactly the same because we know it's not, but we are following almost those two periods to a T at the moment on markets. And when you extrapolate them and put them on top of each other, they do make quite a lot of sense. What about equity valuations? While this chart doesn't go all the way back to 2000, it's still a great one here from Drury and Timmer. And basically it shows you that we have now surpassed, at least in our overall cap weight market, the 2021 highs. So of course, while we don't have all those markets, companies that make no money, we now have the mega caps at higher rates. And you can see the disconnect now between the equal weighted market and the cap weighted market. So if you're looking at where's the value, well, maybe it is in the equal weighted market. And there are some points which we can talk about in the future if the market is going to actually start to consolidate here, that maybe equal weight will start to play a little bit of catch up, though that's going to be the guess and price action will need to be there. Equity valuations, well, we can see here 17.6 and 23.8, two big numbers in terms of how far away they are. And we've actually seen these equity valuations generally be very connected ever since the global financial crisis. This is the biggest disconnect we now have between the S&P 500 equal weight trailing PE, and the cap weight itself. Again, a very interesting chart and just shows you where we're at. Now, where does this all lie back down to? Well, you've probably heard the idea of equity risk premium. And equity risk premium basically is telling us by the general metric, when you take a look at the overall cost of the market to be in the risk of the market versus bonds, makes absolutely no sense almost to buy the market right now. But if you look at one of the other ways of doing it, which is implied equity risk premium, at the current rates, as you can see here, Drew and Tim has put it through, it basically does make sense that the market is at this price. Now, if that was to fall though, this IRP was to fall even a little bit, well, we could be going all the way back down to the 16 ratio. So it's very important that the market remains elevated in the way that it does. And this is a story that I think we'll be unpacking in another video in a deep dive. So certainly sub for that if you're interested in finding out more about it. Here's the old way of looking at equity risk premium, and you can see that the market makes absolutely no sense to where we are right now from that particular read. Something that also was showing up in, guess what, the 1960s and the 1990s. Now, a few of you mentioned that we missed this chart as in it was cut off in the last video, so I thought I'd share it. This obviously shows us the shorts that are going through in the Chinese market right now and how they've been elevated and really, really high. It also, if you put it on the screen, you'll notice that when we do have so much of this shorts, over the next middle term, that is basically the next 6, 12, 18 months, pretty much all the time, China stocks have been going up. So, of course, they're doing everything they can to support the market over there right now, and I thought that was a great chart to be putting in. Now, for people that are freaking out and saying, oh, maybe this is the end, maybe this is the big sell of markets, these dark pools look pretty bad, we do need to remember that bull markets, even those ones that did sell, the 60s and the 90s around this period of time, did end up going higher. And the median duration of a bull market has usually maintained between 31 and 33 months. So we're not quite at those levels yet that are the nosebleeds of what markets can get to. Another big volume trade that I thought was interesting to note was this one here from silver. Now, if you've been following silver and gold stocks, they were once the hottest thing only a few months ago. Then they became not so hot, and now they're consolidating at very interesting levels. Now, we just saw a big read come through for silver. Take of that what you will, but certainly interesting to be watching. All right, let's move over to the flows before we go into the S&P 500 chart and the biggest transactions going through there. And you can see here that we had a mixture day on the Friday options expiration. We did sell, and we expected that to happen, but we continue to see that little bit of rotation coming through, at least in comparison to others, from XLY. So consumer discretionary improving out of nowhere. Also home construction also improving, which is something we've mentioned now for a couple of weeks. And you can see it here on the chart when we look at the last 5 days. Gold, XLY, and even financials out in top when it comes to some of these performances here. And while I do have semiconductors down here. While I'm looking at this type of chart, it basically is telling me that rotation is occurring. And I think that semiconductors might have just topped for now, as in we may be going into a consolidation period. And hear me out when we go into some of the other charts for that, because consolidation doesn't mean sell, doesn't mean exactly it's going to explode or anything, but it's something this market has done. It's been rally all of the Mag 7, Mag top 10 stocks, consolidate, push the rest of the market, consolidate the rest of the market or even sell it off, and then rally those top 10 stocks again. Could we be at that point? Let us know in the comments down below. I'm tending to think we might be. Let's now have a look at the S&P 500 from the perspective of, is it overbought? The simple answer, I'd say so. There's a few signs. We've got extended markets, which are, of course, pushing to these new highs. And we've also got a sign here that basically is hitting a 5,500. Now, with the NASDAQ hitting 20,000 at the same point, it can be a bit worrisome. Those two psychological levels, I know that I used to work in these types of fields, and people really like those numbers. Like if you said to someone, oh, where would you like to take profit? If you said, what about 20,000? They would say, absolutely. If you said 19,960, they'd say, why not make it 20,000, if you get what I'm saying. So when you do hit these levels, you tend to see huge sell walls and huge amounts of level 1 and level 2 data going through. So of course, it makes sense that dark pool transactions were on the rise last week. Now let's have a look at the key levels here for the US 500. I have posted these over on our X account if you want to follow along and check them out. And I think we probably nailed the concepts last week of seeing a bit of selling around this level. We also got some exhaustion techniques coming through the US 500. And we know that the main levels to be watching this week are going to be 54.30 and then, of course, 53.50. 53.50 and 54.30 are going to be the two zones where I could see buyers come back in. Effectively, they may bounce this zone here, and this would be a better zone also to bounce. With strong transactions that have gone through the 5300 zone, I think it's going to be difficult for the market to get below that anytime soon, especially if breadth starts to actually improve across the board, which it hasn't been doing so. Let's have a look at the options for the Monday and then, of course, the Tuesday. And you'll notice here that we do get a decent amount of options on the Monday themselves and a huge amount of puts sitting above the current spot. So you'll notice here put support's actually sitting at 54.75 and the current market close was 54.65. So if the market does stay below 54.75 throughout the session, let's go past lunchtime session, then we might be in a negative gamma situation at that point. We probably would be. And that would actually be pushing the market down as hedges would have to come through to transact throughout the session. So this would actually be quite a negative flow day, you would think, for the markets, possibly more selling on Monday if the market can't hold up. Now, if the market does hold up and expire in between kind of 54.75 to 5500, I think 5500 could be where we start to see some sells come through. Now, this will be a very interesting point here for the markets and something I would be focused in on very, very closely, because 5500 in particular, we know is a psychological zone. We also know it has still a lot of calls on it. Have a look here at even the Tuesday, huge amounts of calls. So even if the market rallies to 5500, I would expect a seller to still be trying to sit around that zone for now. Let's have a look at the CTAs. CTAs dropped positions slightly in the S&P, same with the NASDAQ over the last couple of sessions. And of course, Brent also was dropping, which is an interesting one there. And gold was on the increase as well. So that silver chart that we saw before with the dark pool activity, maybe gold and silver are starting to find a little bit of legs. Let's move over to the other major stocks. NVDA, as we know, 140 was the huge strike off. This week coming, 140 again remains, I think, too much for the market to get through easily. And we have now turned more into a negative gamma situation. So effectively, we went from positive gamma all the time to suddenly the puts getting stacked. And this is, I guess you would say, supportive of the market seeing a little bit of a sell on these stocks, which we'll look at in the charts, and not necessarily as much buying as we had. It was an amazing run. Maybe it's time to consolidate. Same thing with Tesla, except the opposite way. Tesla is still starting to improve. We end up closing at 183, which is not quite a breakout of the 185 zone, but 185 is a very, very important zone. And we would expect this to be a huge flow event if we manage to get back above 185. I think 200 is still on the cards for Tesla, at least in terms of the current price action and where the markets could be flowing next week. All right, let's jump into the charts together, guys. Not too much coming in here from our options and bond market kind of indicator. You can see here it dropped a little bit. It was showing us some signs of warning last week, so we'll continue to watch it throughout this week. And that all came in at the time that we thought it would, and the US 2-year remained in that 4.7 level. So just remember with the yields, the main thing here is to see whether they're holding these support zones. There's the 10-year holding in as best it can. As long as it holds there, you wouldn't think that's going to be the big storyline of the current points, and I think it isn't. I think the biggest storyline right now has to be to do with everything from the market's perspective of flows, the biggest amounts of transactions going through. XLY versus XLP, we continue to see an improvement in the overall American Consumer Index, which is the way we kind of track it here. I think a lot of this is buy now, pay later starting to come through in the summer months and people anticipating some okay earnings from consumer discretionary. Does that mean it's good long term? I don't think so, but at the moment, a little bit of improvement here in consumer discretionary, which we were tracking, of course, a few weeks ago using things like Shop, which did very, very well. US dollar, this is an interesting one. Right on the 105.50 zone, actually a strong weekly close for it. If anything, this is pointing towards stronger dollar moving forward. And if that's true, and we're actually getting a stronger dollar, remember this is now 1, 2, 3 week rejections to the upside, then next stop's 106 and possibly even higher after that. Now that can also show you money coming out of the stock market. So there's that old adage that US dollar up, stock market down. And at this point, yeah, it doesn't look weak, that's for sure. It's actually quite a strong close for the US dollar. What about copper? Well, it didn't like it. Copper coming back to the 20 moving average, which we know is the most important of the indicators for this chart at the moment. You can see the support and the resistance that's been formed off it, failing to get above that 470, which we need for a swing. And the tweezer, while it gave a little bit of a gain, it hasn't held again. And if this tweezer edge actually knocked below, then copper could be falling even further down. And as we know, this is a very important point for copper. It must hold the 450, and if it fails to do so, then it could even go as low as $4.25 or even $4. I still remain bullish on copper over the next, kind of 12, 18 months, but this is not exactly the weekly candle that you would want. Let's move over to gold. Again, rejection candle coming through. Some decent CTA action coming in, not above that 2380 level, 2378 level. So again, no bulls coming through that yet, and no bears being able to push it below 2286. So I'd say it's range bound for now. And silver might be the one that you also want to watch, because both tend to move very, very similar with each other, and silver again getting an engulfed to the downside. So yeah, both markets that may still be floundering, and I don't think we've got a strong sign on them yet, though I will be watching silver stock and of course gold stock and gold miners in particular, because you'll notice that they're doing better, and they've got those they're actually way behind silver and gold price, spot price, and they've got some nice transactions coming through as we're starting to see those dark pools hammering in. So certainly one we'll be watching. US oil, temporary top for now. Obviously, I am at the moment bullish on this. So I think pullback, especially to the 78.20 a barrel, could be quite bullish for oil. And I'm looking for that to kind of follow through, hopefully, in the future. What about Tesla? Well, Tesla's doing pretty nicely. It managed to break above some points. Let's have a look at the weekly here. So weekly closed at a new high, right on the 20 moving average, of course, which is always a tough point to then say, well, it's clearly going higher or not. But I think this is the first sign of strength after all of those consolidatory candles. We've got 1, 2, 3, and 4 equilibrium candles. We've got a bullish candle here, and it does point towards Tesla possibly moving towards the 200. Now with NVDA, we may have what has been a temporary top, and I expect NVIDIA to kind of hover around this point, because I wouldn't necessarily be selling it if I was a investor or longer term, 3, 6, 12 month kind of hodler, but this could be a temporary top. So the reason I say that is because it has all of those hallmarks coming through. Large transaction going through from the CEO. I don't think that really does that much to the stock, but it fell 7%, then ended up falling 11%. That's a fairly significant drop off. It all happens up here at the highs, and it usually will drop a little bit more than usually rally back up. But this can start consolidatory periods, similar to what we saw in March into April, and of course similar to what we saw here in June into December. Now this is exactly what the market needs, and this is not unusual. If we actually look here at the the MAG kind of 7 stocks, the one we're using here, you'll notice that we've seen plenty of these consolidations throughout time with big breakouts. And that's the type of way this market has traded since it came off its bottom back in 22. It's rallied, pushed through, and then what we've usually seen is outperformance of certain other markets during that other period of time. So we've started to see not so much the equal weighted market do that much better, but we have had during this consolidatory period breakouts in things such as the Russell coming off the strong kind of lows, and we also had breakouts in some of the mid caps. So I think the mid caps are going to be what you want to be looking at right now, in particular in the S&P 500, and we'll go through some mid cap kind of ETFs in the next video. So definitely pay attention to that. So mid caps certainly now on the horizon for the future. All right, now let's break down some of the other major markets around the world, and we'll go through here the HSI. And the HSI also is it's the Chinese market, the Hang Seng futures in this case. It's dropped back down after going quite bullish last week. I'd like to see it find strength right where it is now. It's actually come back to the most kind of traded zone throughout this range, and it needs to find a buyer pretty much in the next session. Not good to make a new low here. Obviously got through the first level we liked, which is 18.2. Not able to get through the investor swing level. It's 18.6, so make sure to have 18.6 on there. And all eyes will be actually on Tencent. So Tencent must break to a new high, and you'll be looking for that to come through over the next week. Still holding the 20 moving average. This stock is the one to watch for China. Let's move over to the NASDAQ, 20,000. Signs of exhaustion. Again, everything kind of marks the idea that we're getting into a period of just having a bit of a sideways or even downward market. There are some major levels that you may want to focus on, something around 18.5 to 18.6 in the future if it does pull back down there. But I think I'd use the S&P zones that we spoke about before and then actually use those to mark your NVIDIA levels as well. US 30. Now, this could be where we're starting to, even though these are large caps, the mid-cap large, well, we'll call them large caps, but they're actually kind of trading like mid-caps in some ways. They showed significant improvement near the end of last week. Take a look here at the Dow. We've been talking a lot about this supply. We pressured this supply and we came back up. And what this is telling me is that the Dow actually might see better performance than the AI stocks over the next coming weeks. And I think the Dow is well worth watching. So certainly one that we want to be paying attention to. US 2K, as you know, this has been very underperforming. Something to look at. KRE really the big issue here, and regional banks being a big part of it. Remember to look generally at the growth side of the US 2K. So US 1000 growth has been a much better fund. Again, I think mid-caps and even the Dow, yes, the Dow is actually the one I would be watching most closely. All right, let's move over to Bitcoin now. So this market has been really poor, and it's come back down to this watch reaction level. It saw a reaction. It still hasn't got through our first bull level or major bull swing zone. I'm watching, I'm paying attention to it. I really like the technicals on this chart at the moment, but what you'll notice is that this level is so big now because this first bull level just got even stronger if the market's able to break through it. Take a look at this rejection coming off the supply. It's another one of those lower lows, lower highs, lower lows, lower high situation. This is firmly in a downtrend on the daily. So it needs to break that out. And if it does, pretty nice. I'm certainly paying a lot of attention to crypto more than I have. And if you look at the alt market, it looks like the alt market wants to drop a little bit more first before hitting almost great supports across the board. So we will be paying attention to that. For the week ahead, are there any major bits of news that are worth paying attention to? Well, there's always something, of course. We've got FOMC members coming out and annoying us. You can see there's lots of them that are coming to have a chat. They usually don't do much, though, but they are coming out. And then we've got a few other central banks around the world. We've got final GDP numbers on Thursday at 8:30 a.m. New York time. Pending home sales at 10 a.m., which could be interesting to look at. And then if we scroll down, we've then got the core PCE index, which is at 8:30 a.m. on Friday, June 28th. So that's going to be the one that the Fed often looks at and kind of makes decisions off. Guys, if you enjoyed today's video, please remember to give it a like. Thank you for watching so much, and remember to subscribe, and we'll see you in the next week. I'm looking forward to getting back. Obviously, this week's been a little bit different in terms of schedule, but do remember we usually do it every single day. So thank you for watching, and have a great weekend. Bye for now.